So this is absolutely fantastic what I'm about to show you. A lot of people are very concerned about the state of the US dollar index, especially after today's worth of trade. You can see the index itself, it closed down 67 cents, a very long day dark Morobozu, a very bearish candlestick in and of itself. However, what people are failing to register and what they're failing to catch on to is the very simple fact that this looks like an inverse head and shoulders pattern, and what we are doing potentially at this very moment is back testing the neckline as to what we would expect to happen if we were to see the reversal take place of 2017, which has been a very bearish market, a very sort of, or at least a depreciation in the purchasing power of the US dollar, which is potentially in the month of November. Here we are, set to reverse and actually appreciate into the calendar year of 2017 and potentially very well into that of 2018 also. A lot of people are thinking very short term, or at least what they are failing to see is the larger picture, which has been under construction since we started to develop a lot of this positive divergence. Now again, one of my favorite indicators, it's not my favorite, but when it comes to trend reversals, it is up there on the list of my own personal indications that I look for when we're seeing momentum slow in a trend, and then of course price action and chart patterns to come together and to give us the signals of a true definitive trend reversal. If you pay attention all the way back to, more or less July, when we started to see the major breakdown of the US dollar, a lot of this momentum through to September 2017 was where we saw the tide turn in terms of momentum, and when we started to register a lot of that bullish divergence, otherwise known as positive divergence. So I do like this divergence which has been establishing over the past 4 months. Again, a lot of people are failing to see this as we pull on back down into this critical area. I've been calling for this back test for quite some time. I was a little bit surprised when we started to sort of set up a little bit of a stair step, or potentially that of a stair step consolidation, because I was saying, look, we can break out above 95.22, but what I would like to see in a perfect world, or in a perfect sort of scenario, was to see the actual textbook pullback and the retest of this neckline. Well, as at the close on Tuesday, although this is the ETF, it looks as though we are starting to do this. Now, also, if I take this conversation a little bit further, it's also very interesting to see that it's the first time where price action since breaking above the neckline is coming back down to potentially retest that 50 exponential moving average, which is starting to slope up. So what has been a very bearish slope to that 50 for quite some time, it has sort of bottomed out during late September into the majority of October, and it's only just started to turn out. Now, this isn't all that strong of a signal in and of itself, but even if we do short-term overshoot this 50, say for instance, we come all the way down to 93, even a little bit lower on the US dollar index, what you can say to yourself right now, I mean, you can write this down on a piece of paper, is that, well, look, as long as we don't take out this swing low over here in the month of October, about mid-October, as long as price action remains above this, okay, above this level, well, this could be potentially that third consecutive higher low also, which is potentially under development, more or less where this green rectangular box is drawn on my screen for the US dollar index. Now, what you can also look out for moving forward is to see, well, first of all, the stochastics come back down into more neutral territory, at least down to 50. The RSI has already overshot that, which is fine. But what you want to look for is to see the MACD hold above this neutral histogram line here. So I'm talking not about the actual histogram bars. This just measures the difference, all right, between the fast line and the slow line of the MACD. But what you want to see itself, in and of itself, is to see these two lines remain above the neutral point. Okay, what distinguishes that of favorable or positive momentum and that of negative momentum as well of the trends. So we are in terms of the histogram, we are starting to see acceleration to the downside, but the actual lines themselves are above the neutral point, which is telling us and suggesting to us that we are moving into favorable territory for the MACD, or given the indication by the MACD. Now, if you pay attention to this, when the MACD stays below that signal line or that neutral line, talking about the two buy-sell signals or the crosses which take place, like the stochastics on the MACD itself, generally you're in a bearish trend. But when we push on up above the midpoint of that neutral line, it will register that of a bullish or favorable trend. So if you go back and study this and you pay attention to, well, where is that signal line located in respect to the midpoint, it should unlock a lot of the secrets of what direction the actual trend is. And right now the picture is coming together very, very nicely, not even on sort of the weekly candlestick construction which we're seeing, but also with chart patterns, with terminal reversal signals being the inverse head and shoulders, with the positive divergence forming on the MACD, with the MACD registering in positive territory for really the first time in quite some time. I mean, you have to go all the way back to March 2017 where we temporarily pushed into positive territory, but it really wasn't since, or it hasn't been since January 2017 when we've actually held above this. And these are all very favorable conditions for the US dollar moving forward. So I wouldn't be all that concerned about the very short-term market noise and what appears to be that of a very bearish candlestick, which has just produced itself on Tuesday. I don't think there's much of a chance that we're going to crack below 92.80, if I could just say that in one sentence. Now, why am I dwelling on the US dollar so much? Well, the reason for that is because if we're expecting a major move to come in the US dollar, well, it should have ramifications, so to speak, on commodities. And I mean, I'm seeing a lot of articles about gold and silver, especially over the past 2 days. A lot of articles saying how gold, for instance, is bouncing off its technical support area. What they're failing to see is the big picture. Yes, we have seen a little bit of elevated sort of volume spikes at certain key levels around or between 120 and 121 on the GLD ETF. But if we see the US dollar turn up and appreciate and break above that line that I've just mentioned, what you're going to see is gold eventually crack 119.62. That is a very neutral outlook for gold. I'm not long-term, a perma bull nor a perma bear on GLD or SLV. I'm just looking at the trade opportunity, which is coming from analysis on the US dollar. So you can see how I have two triggers here, 119, 124. Yes, these are triggers, but really what the definitive entry is going to be, what the contingency for gold and silver is going to be, depending on the direction, all right, of the trade for this commodity ETF, is going to be, well, which direction does the US dollar break? And it's my hunch, based off the analysis on the US dollar, that it's going to, or the US dollar itself is going to appreciate in value, and that of gold and silver are going to take out these critical areas of support, and we are going to see a short-term or potentially maybe short to intermediate sort of loss of value on the ETF as we come back down to 116 at a minimum, potentially down to 110 again. And I don't want to sort of upset anyone, but this is the type of opportunity that if you can disconnect yourself emotionally from maybe some preconceived ideas that you may have on gold or silver, even the US dollar index, well then you're really being gifted some really incredible opportunity if you position yourself correctly and if you can hold that position and ride the momentum of the new trend direction. And that's the reason of this video here. The same is true for SLVs. SLV, it looks as though we're nearing the apex, or pretty much we are in the apex of this symmetrical triangle, but at the same time you can see my sort of tentative entries here. If I had to choose between SLV and GLD, I'd choose gold just because of the pricing of that, also the liquidity of the actual contracts themselves when it comes to options. But the trigger for silver remains the same as gold. Pay attention to the US dollar index, and then you can more or less open the trade up in the opposite direction for SLV as well. But it's no surprise that we're moving into a low volatility sort of state. For SLV, you can see the Bollinger Bands constricting price. This is all looking really, really good. And this is some really favorable trade opportunity right here for you right now. So on that note, everyone, I'll say farewell again, and I'll be back with you later in the week. All the best, everyone. It's James signing off on behalf of Pivot Point Trading. Goodbye.